Welcome to our finance tutorial on investment returns. Today, we'll uncover the intricacies of different types of returns, how to calculate them, and their importance in investment strategy. First, let's define what we mean by return. In the simplest terms, return refers to the profit or loss derived from an investment over a particular period. Returns can be expressed in absolute terms, or as a percentage of the original investment. To illustrate, if you buy a stock for $100 and sell it for $120, your absolute return is $20. But more commonly, we refer to this as a 20% return on your investment. Now let's dive deeper into different types of returns, starting with total return. Total return accounts for both the capital gains and the income generated from an investment, such as dividends and interest. For example, if you purchase a stock for $100, it appreciates to $120, and you received $5 in dividends, your total return is $25 or 25%. Next, let's cover annualized return. This measures how much an investment grows annually over a given period. It's particularly useful for comparing investments of different durations. If an investment grows from $100 to $150 over 5 years, the formula for the annualized return would be, it's worth mentioning compound annual growth rate, or CAGR, which is a useful measure of the mean annual growth rate of an investment over a specified period longer than 1 year. For example, if your investment grows from $100 to $200 in 10 years, the CAGR can be calculated using. Another important metric is the internal rate of return, or IRR. It's often used in the context of private equity and real estate investments. IRR takes into account the timing and size of cash flows to compute a discount rate that will result in a net present value of 0. To better understand IRR, consider an investment that costs $1,000 and returns $300 annually for 5 years. Now, let's transition to discussing risk-adjusted return. This metric helps investors understand the return generated on an investment while considering the amount of risk taken. Common measures include the Sharpe ratio, which is calculated as the difference between the return of the investment and the risk-free rate, divided by the investment's standard deviation. For investors seeking to diversify, understanding the correlation of returns is crucial. Correlation measures how returns on two assets move relative to each other. For example, if stock A has an average return of 10% and stock B has an average return of 5%, the correlation coefficient can tell us how their returns move relative to each other. Understanding the real return is also important, especially in times of inflation. Real return adjusts the nominal return of an investment by removing the effects of inflation. Suppose you have an investment with a nominal return of 8% and inflation is 3%. The real return can be calculated using the Fisher equation. Before we wrap up, let's tackle some common questions. Question 1. How do you differentiate between simple and compound returns? Answer. Simple return is straightforward and easy to compute, but it ignores the compounding effect of reinvested earnings. Compound return, on the other hand, provides a more accurate measure of the investment's growth over time. Question 2. What role do taxes play in determining my returns? Answer. Taxes can lower your overall returns. It's important to consider tax-efficient investment strategies and accounts, like IRAs or 401(k)s, to mitigate this impact. Now that you have a comprehensive understanding of returns, use these insights to make informed investment decisions and optimize your portfolio. Thank you for watching.